Oh, yes. Hello. Hello again. Thank you for joining us, Joel. We actually did the same chat. I guess it was the first Ares and Viso Private Credit Summit in Miami in October.
Yep.
We did the same thing. So obviously Miami's very nice. How's Barcelona been?
Barcelona is a better city. I'll say that Barcelona's always been one of my favorite cities in Europe because it's basically to make a U.S. comparison, it's San Diego. Everybody's laid back, everybody's relaxed, it's a very walkable and very likable city. So I'm always happy when I'm in Barcelona.
Good. 2024 feels like it's been a lot more positive as a year in credit on the whole. I guess what sort of surprised you the most?
I was surprised my first question wasn't on Irish tax law. What surprised me the most? I think we expected, in November and December, as we started to see the dreams of rate cuts becoming alive, we expected to see a ripping ABS market. In fact, we were talking internally with the team, and we said, look, we were really, really busy post the bank crisis. At the end of the second quarter with the PacWest portfolio we bought for $3.5 billion. We were really busy on significant risk transfers and capital relief trades in the third and the fourth quarter. We had the busiest fourth quarter we've ever had across the illiquid side of our markets. What surprised me was I fully expected us to be slow in the first quarter on the illiquid side. So if you think of, and I think it's probably a good distinction to make, there's been the conversations, everything we do is asset-based. Everything we do are portfolios. It's basically the illiquid and the liquid side of the ABS market. We really have three pools of capital. We have our insurance solutions pool of capital. We have our kind of core portion of our capital, which effectively call it is 450 spreads to 650 spreads. And then we have our opportunistic pool of capital, which is kind of looking for 11 to 15% plus. But I think that the market, if you were really to define the market and where it's going, and I think it's really relevant to the ABS market broadly, is you should really divide the world not in that way. You should really divide the world into public rated, private rated, and non-rated. Because if you think of the world that way, basically most of the traditional ABS market has been public rated. The transition we're seeing, as we'll talk about, I'm sure later and others, with insurance and others, is a lot of capital is going from what used to be a publicly rated deal into a private rated deal into insurers directly and others, which is included in our insurance solutions and our captive in Aspida, but also is included with regards to our third-party insurance companies. Where we're the leader, we believe we have the largest pool of capital by a lot over anyone, is on the unrated side of capital. So when I say that I expect it to be slow, I expect it to be busy on the public and private rated. I expect it to be slow on the non-rated. And that non-rated piece of the market, we've continued to be very busy, but I look at it as, as much as the ABS markets are back and humming and very bullish right now, there's been 2 years of, fits and starts and stops and back and forth. And so the machine really didn't work for 2 years. And what's happened now is the machine is restarting. And if that machine is restarting, it really creates a huge demand for unrated capital. Because you need the equity, you need the debt, you need the warehouses, you need to originate it. Because if you really take away everything but the CLO market you ramp to the secondary market. Yeah. You ramp the assets are there. You can ramp a new CLO. If you talk about resi, if you talk about consumer, if you talk about autos, you talk about even NAV lending or other things we do, all of those assets have to be created. Those assets have to be originated, they have to be warehoused. And so when you look at the market today and you say, wow, we've had these huge movements and spreads on the public rated side. Well, of course we have. There's no supply. There's massive demand and there's no supply that's out there. So that's what's really surprised me in 2024 is I expected it on the rated side. I've been surprised by how much capital dearth there's been on the unrated side. And so the illiquids continue to be busy. Whereas if you go back a year ago, at the end of 2023, we had the same phenomenon, right? It was the end of inflation. We thought, hey, we peaked. And the markets kind of ripped in the first quarter before the banking crisis. We were quiet as anything on the unrated side. But this has really changed. Even before M&A, even before other markets, it's been really busy on both parts of what we do.
I guess how long is that going to continue?
Well, so part of it's advance rate. part of it is rates, which is the earlier panel said everybody believes in higher for longer. I don't. I don't. I don't see it. I look at the market and I say, okay, so the only thing in the U.S. That's holding up inflation has been shelter. It's been housing costs. I think we can all agree in Europe, rate cuts are coming, and we're effectively near recession or in recessions in certain parts of the EU. And so when you look at the U.S., the only part that's there, it's lagging. If you go back a year and a half ago, the Fed was telling us and PCE was telling us that housing was basically barely inflationary. And we're looking at our portfolio and saying, then why are we getting 9 and 12% rent increases? It's very lagged. And now you look at it and they say, oh, they're starting to see it coming down. It started coming down 9 months ago. Okay. You started to see the rent come down across single-family rental and multifamily and those other areas. So there's a shot that parts of housing become deflationary in the near future. And people forget when they really look at inflation numbers. Services was always 3%. So everything else, the goods and others, were basically deflationary. So if we're in a market where we're returning to that kind of an inflation market and it's just lagged on the data, of course rates are coming down. The question will be, does the Fed screw it up on the way out as they screwed it up on the way in? Do they wait too long? And do they end up causing a recession because they wait so long? Because right now, the pounding on the door that you hear is the banks pounding on the door for the Fed saying, holy frick, just cut rates because you're killing us. Because this inverted curve and the increase in the liabilities the banks are paying right now is destroying banks in the U.S. as well as in Europe. And that NIM is continuing to get shrunk time over time. So you're creating your problems of tomorrow. And that's before you talk Basel Endgame, before you talk commercial real estate.
Yeah, that is, okay. On private credit, it feels like I felt like there's been a bit of a concerted effort to really talk about the asset-backed side. I know you say all you do is asset-backed, but I certainly feel maybe 2 years ago it was like, this is private credit, it's new, this word. And then the last year, let's say, has been how it's going to get into things like securitization.
Yep.
I guess that's going to be ongoing. There's probably a lot more work still to do there. But what's next, maybe, as well as a question?
I think there's a fallacy, and the same fallacy happened in direct lending post-GFC. And the fallacy is this is new.
Yeah.
The fallacy is I've been doing this for 27 years. I got my start with Citigroup 27 years ago, and I was doing assets and lending and origination and putting them on banks' balance sheets. The fallacy is in direct lending, that exact same thing was happening in GFC. So the assets that are getting originated, the deals that are getting done, even public versus private rating, they're the exact same deal. It's just a public rating versus private rating. The illiquid stuff just used to be on banks' balance sheets, used to be in other areas. But if you go broader, and if you go back to, I'm a history geek. If you go back to 10,000 years of written history, all the way till 1970, you had one pillar. You had one money multiplier. If you're a sovereign, you had one pillar and one money multiplier, and it was banks. Whether you're Medici or other times, whatever you're talking about. If you're really going to look at it now, in 1970, something changed, which is securitization market opened up. The beginnings of the securitization market that started in 1970 didn't really start till 1980. Now, if you look at it, you don't have a pillar, you have five. You've got banks, you've got insurance, which are dramatically larger than they were before with the capital they have. You've got securitization market, you've got, I would say, sovereign wealth and pensions, because they kind of act in their own pillar in many ways, and you got private credit. The thing is, all of those work together and compete at the same time. There's a partnership and a competition that's occurring across all of those. There's a synergy that's occurring across those markets. So the assets and the areas are not new. If you look at it, I got a question at a panel like 3-4 months ago. They said, well, asset-based credit, this is really interesting, we get it, but how do we evaluate these managers, with regards to not having track records since this is also new? And I was like, well, I've been doing it for 27 years. Ares has been doing this since 2011. We have a 13-year track record. If somebody doesn't have a track record, it's really easy. Walk away. There's nothing to do. Like, you should have a track record in this space. It's amazing that effectively a $40 trillion total addressable market, there's groups out there, and some of them very large, and some of our largest peers, that have suddenly discovered that there's a $40 trillion market that exists out there. So the market's large. The transition is the same transition that happened in direct lending. If you go back to post-GFC, you're having this transition where banks want to go more boring, the regulators want them to go more boring, because of all of those 5 pillars I mentioned, every one of them has match funding beyond banks.
Yeah.
They're 10-to-1 levered. Private credit is not levered or is 1-to-1. Insurance is levered, but it's 10-to-1 levered, but they're matched funding across that. The only one that borrows short and lends long are banks. And the only one that has federal guarantees in a large way are banks. So, of course, banks should be boring. That is where your systematic risk is. If you look through history, in the 27 years I've been doing this, if you look at it from the standpoint of LTCM, if you look at it with regards to COVID, if you look at the GFC, if you look at LDIs, there's a very simple axis of where basically your systematic risk hits. Banks and the most liquid of assets. Because it's banks over-lending to the most liquid of assets. LTCM was not a bailout of a hedge fund. The hedge fund was a zero. LTCM was a bailout of the banks. If you look at LDI, you look at the COVID on the agency mortgages, it's that access that's there. So all that's occurring is you're taking assets from here and putting them to here. And the thing is, in the U.S. alone, it's $23 trillion of U.S. Balance sheet of banks. Half of that is what we do. So if 1 trillion of that goes to the private credit market, you're already as large as the direct lending market. So that's where you have this tailwind that's turning into this jet stream. That's where this conference, if you fast forward 5 or 6 years from now, will be half private credit and half, frankly, public rated and private rated.
And how are the banks working with you now? You said you touched on it a bit, but they seem to be sometimes collaborating. At least you all sort of do both at the same time.
Look, there's been some of my peers who have said we're here to compete with banks. We're here to partner with banks. We're not here to compete with banks. If you look at it, anything we're doing are things the banks aren't doing. If you think of NAV lending and what we're doing it at either on the rated, private rated basis, that would be just outside of bank spreads on a rated basis, and that's going to be stuff that's going to be at 300 or more. If you look at it on an unrated basis, we start at 450, 500. Banks aren't doing that. If it fits in the bank box, they're still doing it at 250 to 300. They're doing it inside of what we're doing. We're not competing with them. Where banks are partnering is they are providing financing across different pools of assets. Where banks are partnering is we've bought portfolios like PacWest, the $3.5 billion. We've done capital relief trades, and we'll continue to be active in that market, although, frankly, that market's not as interesting as it was a year ago. You've already seen that market. I think it will change near year end, but you've seen that market with a whole bunch of Me Too's, people wanting to come in to raise a fund with not a lot of supply. And so I think that dynamic could change. And we've also partnered with banks with regards to that transition of those assets that are coming to the other side. So whether it's financing, whether it's capital relief, whether it's buying portfolios. If you look at the Ansley Park deal we did on the equipment leasing, which we'll be securitizing to all of you over the next few years. If you look at Ansley Park was a non-core for banks. Because if you're a bank, you have 20 businesses you're in now. With Basel Endgame plus your commercial real estate losses coming, you're going to get it down to the 5 or 10 things you're really good at. Because Basel Endgame kind of levels the playing field. Nobody has their own special model. Everybody has the same model. So you better be really good at adding value in that asset class. So those other 15 to 10 things that you do, a lot of those are going to become non-core. And it's a different answer for every bank. Like, if you look at some, it's not tied to deposits. If you look at others, we kind of suck at it. We have bad loss histories or others. You look at others, it's, hey, this is really unkind with CECL and other type of regulatory things. So as those non-core businesses come out, we're going to be acquiring them as assets or as platforms. We'll be doing the capital relief. We'll be doing the portfolios. But this is all in a partnership with trying to help with the banks, but also they'll be financing us. They'll be sourcing. They'll be selling bonds. There's a very good relationship that goes between us and the banks.
We talk about the private credit firms versus bank relationship. What about these sort of smaller private credit firms and the bigger private credit firms? I think it's often been said that the likes of Ares, they're fine, no problem for them doing all of this stuff.
Yeah.
But the smaller guys have found it a bit naturally more difficult. Do you see a lot of consolidation just becoming inevitable?
Yeah, I mean, if you look at it, we have just under $430 billion across Ares, and over $300 billion of that is credit. and almost all of that is private credit. And we are known for private credit. I think every one of the large firms is known for one or two things, and there's no doubt that that's the area that we consider ourselves the leader. And so, but I would say broadly, it's not like there's going to be one winner. There's going to be 4 or 5 winners. There's going to be some large players that play across that will come at it with different approaches and come at it with different capital. The key is matching up the opportunity set with the capital base, making sure that you have the right type of capital to chase that. We've had some peers who have put all of their weight on one side, which is the insurance or the private rated side. And the failure there is you're ignoring a massive market on the private side. You have some that are very large players that are raising their first fund ever in that space. And so what we've done is we have balance across all 3 pools of capital. If we have great risk, we have a home for it, whether it's insurance, whether it's right down the middle in kind of core type strategies, whether it's something that's more opportunistic. If you go to the smaller players, there will be 4 or 5 winners, and not to offend anyone in the room, but I don't think small players have a reason to exist. I look at it as it's just the natural evolution of private credit. If you look at, the one thing, there's a great book by Will Durant called Lessons from History, and it kind of goes through, the guy wrote 10,000 pages on history over his life, and he did the greatest thing ever. He wrote a Cliff Note version of it for us. It's like 150 pages, so it's digestible. And it goes through basically all of these patterns over history and talks about it. And some simple things of, history follows water, if you think of the rivers and the oceans and others. But a lot of it is mankind advances, mankind moves forward. And if you look at history of finance, it's the same thing. Goldman, if you read The Partnership, the book that goes through the history of Goldman from the beginning to end, they were making a whole bunch of money in the 1970s on block trades, something you can do on Charles Schwab today for $8. Those things don't go backwards. If you look at Vanguard or BlackRock and the consolidation that's occurred across index and EFTs, those things don't go backwards, because ironically, every time regulation is added, another small private credit group dies, because you can't exist from the cost structure that's needed and raise capital. And your large investors want to write large checks. So when you look at sub 10 billion especially, there's this race to attach yourself to a larger pool of capital, because there is this consolidation that's kind of occurring. And so there will be a few, but over time, that advantage you have, if you want to say what's one pattern we have across all of our pipeline today and why we're busy, it's scale. If you actually look at we do deals down to $50 million in size. People like to say we don't. We do them all the time. But if you look at it, the part where the best risk is and the best returns are deals that are 200, 500, a billion. Where we have the ability to write scale, nobody else can do that, and that's a huge advantage. And you don't just write scale, you get better risk. And so that's where it kind of begins and ends.
Do they not keep you honest in other areas?
Well, so I think the fallacy of why people think that there could be all of these small players is private equity. Because private equity, you can have a small team buying companies, you only have a certain number of underlying companies. Even in venture, you kind of can, because there's no massive scale advantage there. There is on fundraising, but there isn't on execution. If you're a good fundamental investor, that's there. The thing in credit is you're not doing 3 deals a year, or 1 deal a year. You're doing a number of deals a year. You're building up large portfolio. You have to have systems. You have to have asset management. You have to have those analytics. All of that goes in there, like operations and infrastructure. And at Ares alone, 13 years, but broader from our careers. Infrastructure is built by putting fingers in dikes. When you have a leak, you fix it, and then you patch it, and then you find another leak and you fix it. You can't create infrastructure out of the air. And so what happens is that when you look at it, and you look at the thing we're most proud of is our loss history since 2011, and keeping that relatively low. You can't recreate that overnight. And so the advantage you have with scale, with that infrastructure, the advantage you have with long track records, it can't be underestimated. And that scale, it's the same reason. You're basically making the analogy of should small banks exist? Hell no, they shouldn't exist. They have no reason to exist. And so if you look at the really small banks, they are totally outcompeted by your large G-SIBs of the world and others and your large multinationals. And that's only going to happen. We had 12,000 banks in the U.S. if you go back to the beginning of 2000. And you look at it today, and we have 4,500. And that number is not going up, it's going down.
Yeah.
That consolidation will only continue to occur.
Changing tack slightly, regulations in Europe are obviously a big topic for everyone in securitization over the last, 20 years. How is it affecting your plans in Europe and in private credit, and the sort of changes that we see coming through?
Yeah, I mean, look, in the States, a big one with the SEC, the appellate courts struck down the private funds rule. So that will have a big ripple, which I think will generally be positive, because there was a lot of regulations were built into that. I think when you think of regulations from bank standpoint, regulations create opportunities. Like, we call our newsletter In the Gaps. We like to think of it as it's written in a way that is kind of Howard Marks-like, but we actually try to say something. We actually put our opinions in there, and we've been pretty bold on, we talked about the bank crisis before the bank crisis. We talked about the fallacy of the music royalties and the prices that were getting done 3 years ago. We talked about the weakening of the consumer 2 years ago. So feel free to sign up. We're very proud of it. We put a lot of work in there in the Gaps. But if you look at it in the Gaps, there's a reason it's called In the Gaps.
Yeah.
The gaps are created by regulations. The gaps are created by accounting. The gaps are created by when the markets are open or when the markets are closed, liquid and other markets. The gaps are created by, does it fit into the bank box? Does it fit into the securitization box? If it doesn't, everything that's done in the ABS market, everything that's done in financial services, we do on the illiquid, on the direct side. If it's in the box, we do it on the insurance solutions, whether it's public rated or private rated for our insurance clients.
And I know there's some sort of proposed changes to Solvency II for insurers. Do you think that's going to have a big impact?
I think Europe has to change Solvency II, because what it's done is the joke of, we went to the gaps, let's go to the box. The joke of the box is you end up forcing everybody into the exact same asset class. And I would argue right now insurance is very heavy on corporates, just because anything with an SPE is a bad, with regards to the treatments. And if you look at the balance sheet of insurance of US and Europe, nothing could be more different. In the US, in Europe, you got a whole bunch of govies and others that are sitting there. You got a lot of corporate exposure. You really have barely anything on the ABS side. And look, people say the ABS market in Europe, it's so small. Well, that's why it's small, because the ABS market in the US was created for insurance companies.
Yeah.
If you look at that, though, it's pushing them all into a bad part of risk. And so in insurance in Europe, generally you end up doing more of your risk on the liability side. In the US, you actually stay boring on a lot of what you do. The annuity market's boring on the liability. You make your money on the asset side because you can. Because if you're forced to, I can't make money on the asset side because I'm so restricted over here. I got to go to the Lloyd's. I got to go do some stuff that's got a little more hair on it. I got to go make my money on the loyalty side or on the liability side. So I do think that those things will change because, one of the things from Will Durant, the pendulum swings. The pendulum swings, it always swings back. And I think that a lot of Solvency II was an overreaction to the GFC.
Yeah.
And I think that you'll see probably an overreaction the other way. I think it's the same thing, the 60-40 model. The overreaction is the 60-40 model is dead. I would say the 60-40 model is just in a different form. It's not fixed income and public equities. The flaw of 60-40 was fixed income. It should be floating. It should be credit. You should have a huge part of your exposure that's credit. It's the downside protection. You should just do it in floating rate exposure, which means I do direct lending, I do CLOs, I participate across asset-based credit and what we do, and we're lending across that. And the public equity should be more private, whether it's real estate equity, infra equity, or private equity. It's more of the changing of what goes into those buckets that changes, but it's not necessarily the credit versus equity component of it.
So what are the sort of the best relative value asset classes you're seeing?
So I'll speak just to our world. Look, we hope that the supply demand at the end of the year swings back, the pendulum swings back with regards to SRTs, and that becomes more interesting again. Right now, it's not as interesting as we like it to be. We continue to be very busy in NAV and fund finance. And in fund finance, you really got to divide it into two categories, the NAV lending. And it's worth saying across fund finance, people talk about it and they really only talk about private equity. We do all four flavors. We do private equity, we do real estate, we do infra, we do secondaries, and that's kind of the Neapolitan of the three because it mixes them in. And if you think of that NAV lending, we've continued to be busy, especially the last 4 or 5 years on the private equity side. We're seeing a pickup, a little bit in infra, a big pickup for all the reasons you can expect in real estate fund finance. And that's an area that we think will continue to grow. And secondaries, because there's been more acceptability of rated, private rated or public rated, there's been a pickup on the secondary side of NAV lending. The other part of fund finance, though, is GP structured. The other part is, why is NAV lending become a bigger thing? Part of it's just the natural evolution. It's like sublines. If you go back to early 2000s, they barely existed. Now everybody has one. I do think NAV will only continue to expand. That evolution is there. But the broader piece is there's no DPI. There's no money coming back to investors. And if you want to raise a fund, I need to return capital. Well, also, if I want to raise fund, I need to put a lot of skin in the game. So GP structured deals where they want to put $400 million in, they'll put $100 million in, we'll put in $300 million. They pledge some management fees or other portions. That area is also continuing to grow because behind the scenes, that allows them to show that ability to put money into the funds and that they believe in what they're doing and help them with the fundraising piece. So I think that those two areas will continue to grow. Net lease, I think, could get interesting again if we start to see the rate decreases. Right now, it's kind of right at that pause period. I think that we'll continue to see non-core come out of banks. We'll continue to see that bank theme play out. We won't see the portfolios because the SRTs open up the valve. So you don't have to sell the portfolios. You don't have to sell your best assets that are floating rate. You can just do something on the capital relief side.
Why is it less interesting to you?
It's less interesting because the same deals we were doing, a year ago are getting done way inside and with higher risk. So what we don't do is black box. I look at it as if I don't know the portfolio, how can I underwrite the risk?
Yeah.
And so some, especially in Europe and some of the corporate IG deals, they'll do it on a black box basis. I don't know how you get comfortable or you stand in front of your LPs when your black box backfires on you.
Yeah.
So we only do them if we can underwrite the portfolio. We've done them against autos. We've looked at them across, student loan portfolios. We've looked across fund finance assets. We've looked across, obviously, the corporates. I think that will pick up because banks don't really do SRT. They want to do them at year end because they want to keep their NIM and their pre-tax income all year and then deal with the regulatory. So ask me in the fourth quarter. You'll start to see a rumbling in the third
Might be
quarter.
something good in that. Yeah.
But right now, the supply demand. I mean, it's the one I always like to give economists the hard time because they're always wrong. Is with economists, the one rule of economics that's always right is supply demand. Supply demand affects all of our markets. Why do we invest on a relative value basis and rotate across everything we do, whether it's rated or unrated? Is because it never stays interesting for 3 to 5 years. There's always these periods where there's just too much demand flows into a small market and makes it wholly uninteresting. There's areas like aircraft that are interesting like once a decade. Otherwise there's not much to do in that area. SRTs are the same. If too much money flows in, then people are going to be taking more risks than they should for less pricing, and that becomes very uninteresting very quickly. So right now we're watching to see where that market goes and see if it's interesting, and if we can underwrite a diverse portfolio. Our advantage is scale. Our advantage is the asset classes that aren't corporate in many ways, because that's where we bring the most expertise to the table.
And is there, on the flip side of all this, is there anything you think that's really overpriced?
A lot's overpriced. I mean, look, I think that this market right now, on the public ABS side, spreads have come in a bigger way because of the same supply demand. There's not enough supply because the engine hasn't got going, the machine hasn't got going. So if you look at corporate OAS as an indicator, we're at 3 standard deviations right now. And if you look out on duration and you say, okay, 10-year assets, it's going to get worse before it gets better because nobody's issuing new 10-year assets and 15-year assets on because who wants to write a liability into this asset class? But there's a huge demand for it from insurance and others. And so you're only going to see this pressing down. That has nothing to do with fundamental credit. The reason that everybody at this conference is so bullish but not very happy, is 2 simple things. We're going to do huge volumes, but everybody's buying what they have to because they're forced to because of the supply-demand imbalance with regards to the markets and others. And if you're at a bank, you're going to do some of your best volumes ever, and your bank's still struggling. That doesn't create a great bonus environment. So I think that the markets that are repriced are definitely more on the liquid side right now. I think on the illiquid side, there's still a lot of opportunity to rotate across the relative value and asset classes, but we've seen certain of those niche areas become wholly uninteresting very quickly.
Yeah. We at the start of this, we sort of talked a little bit about where we see the world going. I guess, what are more clearly your expectations for the rest of the year and into 2025? You spoke about rates a bit, but is there anything else?
Yeah, I do expect rates to come down. I think the ECB will lead us off, and then I think the Fed will not be that far behind. I think the test of this market is not the rate cut. The test of this market is what happens when they do one or two and stop. Because everybody is waiting for the rate cut, and everybody's going to celebrate when they get the first rate cut. But what if we only get two?
Yeah.
What if the thing that nobody's been able to determine is what's the new normal with regards to rates. We know it's not zero, and so somewhere between 0 and 4, there's a number. And if that number is 3.5, this market's going to go, oh crap, that's not anywhere near. And you're going to have to deal with the reality of all of those assets at other rates. So I don't think it's 3.5, but I do think that you're not going to get as many cuts as quickly as you want after the initial cuts are made. So I think that leads to a market, that plus public equities, not a market we play in, but there was a great analysis I saw about 3 weeks ago that basically showed through, post-depression, the history of the equity markets and the correlations with regards to PE and earnings and where we are. And the answer is we should expect for the next 5 years, 6%. Now, 6% for the next 5 years does not mean 6%. 6% means this, right? It means volatility. And I think when you have this kind of public equity expectations where the entire market's trading off NVIDIA, I think that the thing that if we actually have some period of dislocation or volatility, it actually might. Normally it starts in credit and goes to the equity markets. It actually might start in the equity markets because that's priced to perfection more than anything right now.
And just lastly, because I do want to give some time to the questions, so feel free to do it on the Slido. But you do a lot of work around investing with purpose, and I know that's something that's sort of very, very important to you. So do you want to expand on what you guys do at Ares in that?
Yeah, what we've done, and we were the first to do it in this scale, and we're very proud of it, but to be clear, we want everybody to copy it, is our flagship funds on the alternative credit side, which if you go back to a press release on our Pathfinder 2 closing is about $17 billion of capital today. That's the number I can quote. So it's about $17 billion of capital at the time of that press release. All have a charitable tie-in. It was my big ask when I joined Ares. It's about 6 years ago. I went to Mike Arrighetti, our CEO, and I said, "I'm yours if I want to, invest how I always have invested across assets and TAC ops type investing, but I want to have a charity tie-in to what I do next." And it was inspired by a trip to India about 7 years ago. I've supported personally global health for 13, 14 years. I'm a poor preacher's kid that came from nothing. I am the exception of exceptions here. I guarantee I have the worst education of anyone in this room with regards to college and others. Tom's like, well, maybe me. Yeah. I went to a state school because that's what I could afford and others. And so I wanted to come up with a way to give back. The trip to India kind of inspired me to, okay, it's time to do something that has that. And so what we came up with is at least 10% of the promote of our main flagship fund and 5% of our other goes to global health and global education. So it comes out of our pocket, not out of our investors. It's totally bipartisan. You asked the ESG question. We're investing the same way we've always invested. We're doing what we know how to do. I even considered going and running an impact fund, and then I realized I don't know anything about investing in impact. And honestly, I'm not sure a lot of people know that much about investing in impact. So I know how to do what I know how to do, and I love investing. And so how could you tie that with the other passion, which is the charity side? So we've already accrued over $23 million in 4 years that will go to global health and global education. If you run the math forward on there, effectively every $1 billion we have has the potential to generate another $10 to $20 million that will go to global health and global education. It started and inspired the broader foundation at Ares that's apart and separate from that, has already pledged $72 million to a number of other causes across that. And so it's something that we want others to pick up. There's been some others that have, which we're very proud of. And because I look at it as the Wall Street often has that problem of purpose. And if you can invest the way you love to, but also have a purpose tie-in, because look, when we're 85 years old, there's only 3 things that you're going to care about: your close friends and family, your experiences, your trips to Barcelona, your trips to across the globe, your trips to other things with your family and others. And it's purpose. Did you actually do anything to improve this world? Otherwise, why are we floating around this rock? And so from that standpoint, if you think about it, I believe in 3 simple things when it comes to kind of lifting economic situations, because we are focused mainly towards the developing world. If you look at that from the developing world, it's 3 things. One is education, first is health. You have to save the life to be able to educate it. So first is health. There are people dying in poor countries that don't die in rich countries. 160 million lives have been saved through vaccinations basically in the last 20 years through global health. It's that whole bending of the curve we've all learned about. The second thing is education, because even if you save the life, you don't lift out of poverty if you don't educate. The commodity of the future is education. The third is capitalism. The thing that really lifts, hell, I would argue right now that there's India and China and Vietnam in many ways are more capitalistic than EU and the US. They are raw capitalism in its good and its bad forms. And so as much as they're state-controlled and others, it's true capitalism on the street. And so that capitalism lifts, but that capitalism only happens if you save the life and you educate it. And so that lift kind of occurs. And if you look at China, basically went from $300 million below the poverty line to now it's basically like 0.1% of their population. It's those 3 things, that lifts it. So if we can bend the curve, you're changing the rest of it. So to me, the 10% doesn't have to be 10%. It could be 1 or 2%. It doesn't have to be global health and education. That's my passion. I'll argue with you till I'm blue in the face that I think it's the best use of capital. But you do have to do something, because nothing made my life more clear than coming up with that charitable tie-in where you're saying, okay, I know why I'm doing this. We went back to India 2 years ago. We're bringing part of our team to Bangladesh at the end of this year. It will change you forever. It will change you forever, because if you see that and you know why you're doing it, it's not just selling a bond to sell a bond. It's not just making an investment. When you're doing a deal like the PacWest portfolio, it's great to talk about that deal. That deal is going to kick off like $10 to $15 million that will potentially go to global health and global education. If you're 26 years old and you get to work on that transaction, that's pretty cool. That's true purpose, and it gives you this reason as opposed to what's my bonus this year.
Yeah, it's always, you said like Wall Street improving its reputation. I feel like, securitization in particular, there's so many things that are really important for the real economy and for real people. And, like you see in the UK general election, Rishi Sunak, okay, I'm not going to be his biggest fan, but they're like killing him for betting against the market, betting against Britain during the financial crisis. And you're like, yeah, well, that was his job, and he was right, but it's just hard. But yeah, so anything to improve the reputation, it would be good. Shall we move on, lastly,
Sure.
to some of these questions? US presidential elections impact your outlook.
Why did you have to ask about that? That's just not nice at all. I said last night at our dinner, we have 2 candidates nobody wants. From the standpoint of the only person in the world that Biden can beat is Trump, and the only person in the world that Trump can beat is Biden. If you had another candidate on the other side, it would be a landslide. It wouldn't even be close. And I have no answers on how that happened. So we've become very partisan. It is flawed in so many ways. I never thought I would look longingly at UK politics from the standpoint of having multiple parties. I actually think multiple parties would be a very broad part of the solution from a US instead of a 2-party system. But look, to the outlook on inflation and the economy, I can't remember an presidential election year in the US that's been quieter with regards to the impact on the markets. Now, we're getting near the end, so maybe that will change. But I also have a big belief that you ignore that noise. That generally when it comes to elections, when it comes to political, there's always something. North Korea has been near nuclear war for 20 plus years. You know, look, the one I was wrong on was Russia and Ukraine. But if you actually were to say the personal side has been absolutely tragic, the markets has been a relative non-event. So I think generally in investing, you're supposed to move forward and ignore kind of it's the reason I never read books that are current affairs. I only read history when it's 10 years or more, because the current affairs are always wrong. It's always the headlines, they go up and down. Well, the current affair stuff you have to ignore, and you have to look further on the horizon, and you have to make your investments. Because if you're making your investment based on what's going to happen on a presidential election, you're already screwed. I mean, you got no shot.
Yeah, I spoke to a lot of people in US CLOs about it. And they were like, look, the market's busy. They're never going to shut down. Obviously, if something...
It will have ripples. There will be a very big positive and a very big negative if either one is elected.
Yeah.
There's a balancing and a thing that will occur. There'll be less regulations and a whole bunch of chaos if Trump is elected. And there'll be more regulations, and and we'll see where the economy goes if Biden stays in place.
Well, the other interesting one is Biden wins and then it goes really nuts. That could be the slightly...
I don't see that. I think that's more of the same if he wins.
Generative AI driving private credit growth.
I don't think it drives private credit growth. I think AI has been way overstated in many ways. It's a lot of what people are mentioning is AI. 90% of what's being mentioned is AI, is a learning algorithm. And a learning algorithm has been in existence for 10 plus years. So it is clearly getting to levels, and it has more to do with computing power and more to do with what we can, to where you can really drive your analytics and your correlations and others. And I do think that we're only starting to really tap into that. But I don't think it drives the credit growth as much as it just continues to make you a better investor. I am still a very big believer that the most powerful thing in the world is not AI. The most powerful thing in the world is human plus AI. There was, the ability, there's still the ability to drive, it's another tool, and the ability to combine those two things and those lessons learned and those things that you can never teach a computer and never go through. Those are the parts that you power that with AI, and that's where it becomes really powerful. So I don't think it changes the world with regards to the other piece. I think it will have more of an impact on the most liquid of markets because your information is better. Because the main problem you have, I did an interview at our AGM with Mike Milken, who's been a friend and a mentor, and we've done a lot with him over the years. And I told him I did research on pre-interview. I was in your seat. And it was AI, and it talked about the fast food restaurant he started in 2016. And I Googled it, and I couldn't find it. And it was a total hallucination. So it's still human plus AI. You still have to be careful. It's still garbage in, garbage out. It still goes back to my Commodore 64 days of how that works. You still have to be careful, but it's still the most powerful with being used as a tool in combination with human.
That second question about U.S. commercial real estate. I think that's really interesting about what opportunities you see.
Well, the one before the EU, I just want to say, we have a big team in Europe. We're already here. We've been very active. There's a couple articles in the press that have come out in the last couple of days. One of them I'd mentioned on a deal we closed in the fund finance side in partnership with HarborFest, where we were backing a $1.2 billion facility there and participating in that. We continue to be very active in Europe. We also have a team in Australia and New Zealand. We continue to be active in those markets. I think that the banks have always been the biggest player. I think that's backing off, obviously, because there's the commercial real estate. They were huge players, and they have to deal. The commercial real estate problem in Europe is nowhere near the commercial real estate problem with the offices in the U.S., but it's still creating these opportunities. So we continue to be busy on the private ABS side. We continue to be busy with regards to NAV lending and fund finance. We continue to be busy in partnership with real estate on kind of real estate fund finance, as well as our bridge prefs and other transactions that are out there. We're using our scale. We're using our capital to drive that. So sorry, I skipped it.
No, that's fine. But I think we're getting our red flashing light, so I think we're out of time.
No problem. It's great seeing you again, Tom.
Thank you all for listening, and thank you, Joel, for doing the panel.